Good day folks, it's Jim here from Forex. It's the 7th of August. Well, the week's now finished. Much of the week the foreign exchange markets were choppy but range bound really ahead of the US jobs report, and that all changed on Friday once they were released, with the US dollar putting on about 0.5% on the day. The ADP jobs numbers were released midweek, and as so often they were a pretty poor guide as to what to expect from the non-farms. The ADP figures missed badly, but the non-farm payrolls came in at 940,000, I think it was, above expectations of 870,000, and the official employment report was dialed back from 5.7 to 5.4%, so all up it was a pretty healthy set of numbers. As I say, the dollar saw the benefits of this, and we've now got a fairly empty calendar ahead of this week. We've got Chinese inflation data on Monday and US inflation data on Wednesday, I think it is. That aside, there's not an awful lot about, so another choppy week wouldn't really surprise, and I think traders are now going to start to focus on the Jackson Hole Central Bankers Summit, which takes place on the 26th to the 28th of August. So some fairly directionalist trade in the currency markets wouldn't really surprise me. The dollar's now sitting up against good resistance. We're going to have a look at the charts in a minute. Elsewhere, gold took a hit. That came under pressure from a stronger dollar. Oil was also a fair bit lower. I think that lost about 1.3% on Friday. Basically, traders seem to be somewhat concerned about the possibilities of a slowing economy because of the growing Delta strain of the COVID pandemic. So oil is coming under a little bit of pressure for the time being, and I guess that direction will now come from the headlines that we see in coming days as to the ongoing numbers from that. Stocks continue their slow grind higher. I wouldn't be standing in front of that train. A lot of people looking for a pullback, but it's not happening at the moment. Once again, if we do see increasing numbers from the pandemic, then we might see a pullback there. But for the time being, both the S&P and the Dow made new all-time highs again. Anyway, without further ado, we'll go and have a look at the charts and see what they've got to tell us.
Okay, so here we are, starting with a daily dollar index chart as usual. We're really back to where we were a couple of weeks ago. We've had this neckline here, and we were trying to break through it, failed, came back, and now it looks as though we're going to try all over again to push on higher. We're still, we haven't closed at 92.78. We're still below the highs of mid-July, up here at 93.20, and then below this high back here in March at 93.5. So they're going to be solid resistance, and as I say, I don't really expect an awful lot of directional movement in the coming week because there's really not much to drive us on the economic calendar. The biggest issue, I think, is going to be the numbers coming from the Delta variant, so that could drive currency markets. But until we really see anything, I think we're probably going to be fairly range bound. The daily indicators do look as though they're trying to turn a little bit higher. Nothing really in it. The weeklies do suggest that we've got a bit of positive momentum behind us. So it wouldn't surprise me to see the dollar push higher and eventually maybe to test this 93.5 level. And if we can get above that, then I think we might start to put on a bit of speed up to sort of 94.5. But I don't think this is going to be the coming week to do it. And if we go forward now, we're going to have a look at and see what that means for the euro. And here we are. We have a daily chart of the euro here, and you can see that neckline I was just talking about. And we're back here at these previous lows at 117, just about 117.5. And it wouldn't surprise me to see a little bit of a test of the downside on Monday. I'm not sure we're in for anything dramatic. We might get some follow through dollar buying on the back of last week's jobs numbers. But I think this 38.2% FIBO level, if we were to see it, that's basically at just under 117. I'd probably be looking to buy it there on Monday if we see it down there. We've got this particular low here. That's at 117 the figure. So I think we're probably going to base out around there if we do get down there. If we were to break through this though, and this low here, which equates to that 93.5 level, I just mentioned in the dollar index, that would come in at sort of 116 basically. So that would add further support. On the top side, I really don't see us for the coming week really getting back above sort of 118.5, 118.75. We did test 119 last week. It failed pretty dismally there. If we were to go above there, then I guess we can start to move back towards this confluence of moving averages, and that comes in around sort of 119.80, 120 the figure or so, but I don't think we're going there. So really what I'd be doing, if we come back to the shorter term charts, here we have an hourly. Euro was trading around here prior to the data on Friday, and then we saw this sharp move lower. On the 4 hour charts, we've got this double bottom here. The hourly indicators, though, they are pointing lower, so I do think we're likely to see a test of this level on Monday, with the possibility of moving back down towards here. As I say, that would take us down to 117, where the Fibo support on the daily charts comes in at the 38.2 level. So that's my view for the time being. I'd look to be buying it at 117 on Monday, with a pretty tight stop below there. Equally on the top side early in the week, I'd be looking to sell it above 118, I guess, with a stop loss placed above 118.5. The daily indicators might be turning a little bit lower, but really I don't think we're going to see anything too directional in the week ahead. So look for the range trade, I think. Moving forward to dollar yen. Dollar yen ended the previous week at around 109.60. As we said, this is a weekly chart of dollar yen, and as we said, we thought this 200 week moving average was going to be important if we saw it and was a place to be buying some dollars. It did get down there. I'm not. The low of the week was 108.70. So that would have been a good level to buy it, because having reached down there, we then climbed sharply after the non-farms back to 110.20. Let's go and have a look at a 4 hour chart. So this was the low of the week, and then we climbed quite sharply heading into the weekend as the numbers were released. Looking ahead for dollar yen, I think the US inflation data is going to be important on Wednesday. If that's a strong number, we can expect US yields to head higher, and that'll be very supportive of dollar yen. On the other side of the coin, though, we've got COVID numbers exploding again, and that could signal a major downturn in risk sentiment, in which case we're going to see demand for the yen come back into play, and dollar yen will head sharply lower. For the time being, the 4 hour indicators look positive, the dailies mildly positive, and the weeklies are really not telling us an awful lot. So really, for the time being, I'd be looking to buy dips. The stock market looks healthy. The risk sentiment looks positive. So I think you've probably got to go with it. I'd be buying dips of 109.80 early in the week. If we see it down there, a little bit of a pullback with a stop loss probably below this is a 100-day moving average here, 109.60. So I'd have a stop loss, say, below 109.5, but looking for a move on towards these highs here. That's a 110.70, and perhaps even towards 111 again. I wouldn't be looking for too much beyond that, and keep your stops tight, because any change in risk sentiment will see a swift change in direction. Cable, sterling was left out of the action pretty much last week. It only finished 30 points below its close of the previous week. It might be building a little bit of a bull flag here. Who knows? We need to see a break of this, but I really can't see sterling heading sharply to the top side unless the US dollar really dramatically weakens and the euro bounces back strongly. So maybe we just see further choppy trade within these kind of parameters here. The 4 hour indicators are pretty mixed. The dailies not showing us an awful lot either. And we're stuck between the 100 at 139.25 and the 200 day moving average at 137.25. Probably for the time being, just trade that range, because we're not getting much help from the momentum indicators at all. The Aussie's not doing a great deal. I think we said last week that 73 to 74 should pretty much cover it, and that's pretty much what happened. We did make a bit of a squeeze up to 74.25 here during the week, but ultimately it failed up there. Had another test of 74, but failed again, and we've closed back at 73.5 for the time being. It looks like we could have a little bit of a bear flag actually on the hourly charts for the Aussie. The hourlies are pointing a bit lower, but I think, if we saw it back down towards 73, there's probably a buy again. On the 4 hour charts, they might be heading a bit lower. and the dailies not telling us a great deal. I think the Aussie is going to be rather held hostage to whatever happens with lockdown in Victoria and particularly New South Wales. So I really don't see too much upside for the Aussie at the moment. I'd probably rather trade it on the short side. And if we were to break below 73, going back to the daily charts, we've got support down here at sort of 72.80 or so. That's that low of a couple of weeks ago. And then below there we've got various levels of support, but I don't really see us doing an awful lot directionally in the next few days, unless the numbers grow increasingly severe, particularly, as I say, in Sydney. Moving on to the Kiwi, and here we have a 4-hour chart of the Kiwi. The Kiwi did see a sharp move higher, but it failed to stay up there, and it's come back down to this 70 the figure. Once again, I think you trade that range. I don't really think we're going, as I said last week, if you're going to be short, keep a stop loss above this high here, which is at sort of 71.05. On the downside, I'd be looking to buy dips down towards 69 with a stop loss below 68.80, and in the meantime trade that range. The 4-hour charts look a bit heavy to start the week. The dailies, if anything, look slightly positive, but we have got this 100 and 200 day moving average converging here, and I think that'll remain pretty steady resistance if we do head towards the upside. That they're converging just under 71 the figure. Okay, that's about that. Moving along to the stock markets, and here we have a daily chart of the S&P. And as I said earlier, just don't stand in front of a moving train because you're going to get run over. There's a lot of people looking for a pullback in the S&P, and I think eventually they're obviously going to be right, but getting your timing right is very, very difficult. So for now, I prefer to play it from the long side. If we were to go back down towards this level here, which is just above 4,300, really, it's a 100-point pullback, I'd be tempted to buy it, quite frankly. There's an awful lot of cash sitting on the sidelines looking for a home. Because they're not getting any benefit from the bond market. The yields are very poor. So I'd be looking for a pullback here. If we were to go below 4,300, I'd probably be thinking we can probably head back towards 4,200. But once again, I'd be looking to buy the dips. The daily charts, not really telling us an awful lot. Perhaps we've got some mild bearish divergence here. So a 100-point pullback, I don't think it would cause too much of a problem, really. I think it would be healthy for the market. The 4-hour charts, for Monday, the indicators beginning to point higher again, so it wouldn't surprise me to see a reasonably healthy start to the week, perhaps some follow-through buying on the back of last week's jobs data. The dailies, as I say, they're not telling us an awful lot. The weeklies, well, they are overbought, but they have been overbought for quite a while now and show no real sign of pulling back. So I think you've just got to go with it and stick with the longs. Be cautious about it. I don't think I'd have too much in it, but certainly play it from the long side. The Dow and the NzdUsd, pretty much the same. We won't go there. The Aussie market, here we have a chart of the ASX 200. And despite lockdowns and COVID and pandemics and all that sort of thing, the Aussie market, it finished New York, the futures at an all-time high. The current level is 75.60. And frankly, it looks to me as though we're going higher. The dailies, not showing us an awful lot, but they might be winding up to push on higher. Maybe we do see a move to 7,600 or so. The 4-hour charts, they look positive to start the week on Monday as well. And they're not particularly overbought. So I think you probably look to buy dips. Keep an eye on the iron ore price, which has fallen pretty sharply in the last week or so, and that might have a bit of a bearing on the miners, which have quite an important component in the index, the Australian index, of course. So that may not help, but the lower currency is not actually doing us any harm at all. It's underpinning the market, if anything. So I think the Aussie market would probably see a march towards 7,600 in the coming few days. The weekly charts, once again, they're mildly overbought, but not really looking to turn lower. And if we head forward to the monthlies, the momentum indicators here do look really quite positive still. So I certainly like to be playing the Aussie market from the long side. And I think it could actually outperform the US markets once Sydney eventually gets its numbers under control regarding COVID and the economy starts to motor again. I think we could really see some quite decent upside for the Aussie market. So I prefer to be long of that rather than the US markets at these current levels. One thing that doesn't look quite so good is gold at the moment. We'll have a look at that. So here we have an hourly chart of gold, and having wandered sideways early last week, we saw this spike up. That was after the ADP numbers. and then a swift reversal after I think it was ISM manufacturing data came out on Wednesday. Then we drifted a little bit lower, and this is the move after the non-farm payrolls. We're now back down here at this 1760, having taken out this quite important level of support here, 1795. It went through there like a knife through butter. The hourlies are pretty oversold now, so I wouldn't be selling it down here. I think we might see a bit of a pullback. But the 4-hour charts, they are definitely looking heavy, and further downside later in the week would not really surprise. So if we were to see a pullback on those hourly charts, the areas to be looking to sell into are this sort of 17 3/4, or ideally sort of 1785, and you would keep your stop loss above 1795, or probably above 1803 is the 61.8% FIBO level. Having said that, although I like selling it in the short term, the weeklies, now as you can see here, they're not telling us an awful lot directionally, but this is good support here going back to March 2019, and we've got several points of support, and we're currently coming to meet it again, which is just around 17.5. If we go through 1750, then the 100-day moving average is at 1730. So while I like sort of selling it at sort of 1785, 1790 at the moment, I'd equally probably be looking to be a buyer into a dip around 1750. With backup support at 1730, looking for another leg higher. If we were to have a weekly close below 1730, I'd be right out of everything, because then I think we could possibly come back down here and test this level down at the FIBO level down at 16 3/4. So you don't want to be long down there. In the bigger picture, this could easily be a triangle that we're building here. So if this support were to hold down around here, we could then start maybe the next leg higher. I don't really see that happening at this point in time, but it's something worth to keep an eye on. So as I say, at the moment, look to be buying it at around 17.5 to 1730. Actually, I will just show you one other chart I've got on gold. This is a monthly chart that I keep on gold just to keep an eye on. Now the indicators are still pointing lower, so I'm not really in much of a hurry to buy it at this point in time. Those of you who've seen this before, just move along quickly, I would. But this is I think is a cup and handle formation, and ultimately if the handle keeps keeps forming, we can easily move back down to 1600 without really breaking this formation. But eventually this turns into a very bullish scenario down the track. Now, as I say, this is a monthly chart, so it's very slow moving, and I'll probably be retired before we actually do anything, but it is worth keeping an eye on. The parameters, let me just rearrange this. Okay, here we are. So if I'm right, we can move back down here to this sort of 1600 level within the handle, but the objective, if I'm right in this being a cup and handle, we can head way up here down the track to above $3,000 an ounce. So it's just something to keep an eye on, but that's what I'm basing my short-term trading view on, is the fact that we're still in this handle, and I therefore wouldn't really be getting too involved at this point in time. We're sitting right in the middle of this correction at the moment, if I'm right on that, and we could easily, as I say, move back down, hit the base here. But ultimately, I'm looking for a break to the top side. Okay, that's enough of gold. Oil. Okay, so here we are with a 4-hour chart of West Texas. We're sitting above FIBO support and this rising trend support here. The 4-hour charts look a bit heavy, not really telling us an awful lot, but the support is quite firm here. If we look on the daily charts, we've got the 100-day moving average, we've got the rising trend support, and we've got the first minor FIBO level as well. So that could well hold for the time being at around this sort of 66.5 level. Maybe look to be buying it there, but I'd have a pretty tight stop below there, I think. If we do take out that 65 level, which is this level here, then we can head back down to this particular level here, 61.5, and the major FIBO level at 60.5. The daily indicators looking a little bit heavy, the weeklies equally looking a little bit heavy, and possibly looking to accelerate, I think, if anything. So probably looking to sell rallies in oil with a stop loss probably above $70 a barrel by now, and looking for that downside target initially at 65, but further out at sort of $60 a barrel. Let's go back to the dailies. The 200-day moving average comes in just below there. If we do get short, I'd be looking to take profit really just above $60 a barrel, I think. A lot depends on COVID numbers, particularly out of the States. If they look set to increase, then oil is going to come lower, and it's probably not going to do much good for the stock markets either, which could be where we get our correction from if that's going to happen. So that's about that. Before we stop here, we'll just have a quick look at the calendar, although there's not an awful lot on it this week. Okay, here we go. So looking ahead to Monday, it'll be the Chinese inflation data that will take all the interest. There's not an awful lot else out really. The Centix is coming out from Europe, but that's about it. Nothing really from the States. Tuesdays, the business confidence, Australian business confidence, that shouldn't really move the market too much. Some more Chinese data. We've got the ZEW coming out from Europe on Tuesday, and then some secondary US data along with the API weekly numbers coming out for oil. Wednesday, we've got inflation data coming out from Germany, and then later in the day from the States. So that'll be the highlight of the week, I think. So really, apart from that, there's not an awful lot. Quarterly GDP and manufacturing numbers coming out of the UK. The PPI from the States, so that might have a bit of a push on the market. So the jobless claims, of course, the weekly jobless claims. And then on Friday, once again, very little at all, apart from the consumer sentiment index, but that's about it. So it's a pretty light week, and as I said earlier, I think most of the market's going to be honing in on the Jackson Hole conference taking place at the end of August. So really look for more range-bound trade, I think, in the foreign exchange markets, but with some possible directional moves in stocks and commodities. That's about it. So we'll leave it there for now, folks, and we'll talk to you later. Cheers, bye.